Hello, everyone. Welcome. Glad to have our credit union members joining us today for our mutual funds webinar. My name is Christina. I'm the financial wellness program manager here at the credit union, and my special guest today is Ryan Graham. Ryan, how are you?
I'm doing well. How are you?
Awesome. I just want to give a quick intro of Ryan before we jump into our content today. These webinars, we've been doing this series where we kind of tackle some of the big questions in the financial advisory world. And these guys, we've got Ryan, we have Tony and Anthony. They really have a good, well-rounded background. And Ryan actually has been in the industry for 20 years. You've been at Copper State Credit Union for just over a year, right?
Yeah, it's flown by.
Awesome. And you've mentioned to me many times that your favorite part of the job is helping people understand what's available to them. And just knowing that it's not a cookie cutter, one size fits all option for your investments, for your retirement, and for all that stuff. So I really like that that's your favorite part of the job. And as I do these webinars with the financial advisors, I make them answer one kind of ridiculous question. If you could have a superpower, what would it be?
So I picked basically night vision. So it would be nice to be able to barbecue at any time without having a ton of lights on and distracting people. And then my wife and I like to go bike riding, and obviously at night that can be kind of tough. So I think it'd be fun to be able to do that.
Very cool. So as we are about to begin, I do want to make sure, as you can see on the screen here, but I want to make sure everyone is aware that securities are offered through Securities America Incorporated, member Financial Industry Regulatory Authority, and Securities Investor Protection Corporation. Advisory services are offered through PFG Advisors, Copper State Wealth Management Services, Copper State Credit Union, Securities America, and PFG Advisors are separate entities. Securities America and its representatives do not provide tax or legal advice. Investments are not NCUA insured. There's no credit union guarantee, and they may lose value. So talking about real life investments here, got to make sure we let everyone know the details on that. And as we continue here, I'm going to throw up a poll and allow everyone to vote. So it's kind of a long question, but really it's, what do you think the 20-year annualized return by the average self-directed investor is? Now, to me, that was kind of complicated. So I had Ryan, simplify it for me. The average percent yearly an investor earns on their portfolio by doing it themselves. So this is like me, average Joe, trying to manage my own investments and portfolio. What do you think someone like me is going to average on a yearly basis? And I see some answers rolling in here. Everyone go ahead and get those poll answers in.
This is one of my favorite questions.
Wow. We have a couple people who are saying that the average self-directed investor like me is actually going to lose money. The negative 1.9, that's the confidence that our audience has in you, Ryan.
Right. We'll turn that around for you.
1.9%.
Yeah.
All right. So go ahead and just give us the answer. What is it?
It's 2.9.
To do it themselves.
Yeah, it's 2.9. So we looked back over the last little over 20 years. JP Morgan puts out a report in their guide to the markets every year, and it looks at all the different categories. And one of the categories on there was the average investor at 2.9% on average, which is definitely beating bank accounts, which is wonderful. But if we would have just invested in the broader stock market, you would have averaged about 7.5%.
Okay, so you pick something like the S&P 500, that's going to be about 7.5%.
Exactly. Which is a pretty
compared
good
to the
average because
2.9.
Yep.
So comparing that to a 2.9, doing it yourself, yeah, very interesting. Well, I like that question. I think it's kind of fun. We're going to jump in here as the slide shows into some benefits of mutual funds. But I think before we go there, let's just talk about on a very simple basis, what is a mutual fund? Because a few different terms are thrown around a lot in the investment world. Mutual funds, ETFs, and kind of trying to understand the differences between those. So can you start by just giving me a real basic definition of what is a mutual fund?
Yeah, great question. So basically, it is a product that people can invest in with other people, institutions, and it basically has stocks and bonds inside of the account. It can also have what's called commodities, which can be, alternative assets. So what they do is they help navigate, the crazy world that we live in, and can really help give diversity to our members that have maybe smaller dollar amounts and still want exposure to different companies.
So it's a group. It's a group, you're saying, of different investments, I guess.
Exactly. So there's a management team that actually picks the individual holdings inside of the account.
Okay.
They basically build out the fund to the mandate of whatever they're trying to accomplish. So if somebody is a moderate investor, which means
what's an example of a mandate or a goal? Can you give
yeah,
me
exactly.
example?
So, most of us are more of moderate allocation type people. We don't want the full swing of the markets, because if things go down, it really hurts to lose money. So a moderate investor is going to have a mix of about 60% in stocks and about 40% in bonds.
Okay.
So when the mutual fund takes a moderate allocation, they're going to have a good percentage of it in US stocks. They're going to have some international stocks inside of the account. And then they're going to have a variety of different types of bonds inside of it as well.
Okay. Now, on the other hand, tell me a little bit about ETFs, because these two are talked about pretty commonly together. So tell me what an ETF is.
Definitely. So it's an exchange traded fund.
Okay.
And if you look, there's lots of different indexes out there. So there's the Dow Jones, there's the S&P 500, there's the Barclays Bond Index.
And
so
those are all ETFs.
They're indexes, right? So there's companies out there that can basically build out an ETF portfolio for you that mirrors the index.
Okay.
So the advantage is they're very inexpensive to get into, and they're very inexpensive to manage them because there's no managing it. With the S&P 500, you're going to have all 500 companies inside of the account, where a mutual fund might only have 300 of those companies because maybe the other 200 are struggling because of COVID or some sort of financial event that happened.
Okay. So with an ETF, it sounds like you have to purchase the whole entire thing.
Exactly.
And tell me a little bit more about that.
Yeah. So when you're investing in like the Dow or the S&P, basically you don't have a choice on what companies you're working with.
So you can't say, oh yeah, I want these 499 and not
right.
this one.
Right. So the idea of a mutual fund is you pay a little bit more in fees, but you really get added value for what you're paying. And basically we're allowing these fund managers to go out to these 500 companies and really pick and choose what they're going to be investing in. When we think back,
so would you say mutual funds are actively managed then?
Yes.
Like, by a team?
Definitely. So they're always buying and selling inside of the account.
Okay, so they can change. They can change quite a bit.
Yeah, and it's very rare that an index changes, what's inside of it. You'll hear on the news sometimes, oh, a company was added to the S&P 500 or a company was dropped off the S&P 500.
But it's not like super often that big changes are made
Correct.
in those, whereas with a mutual fund it can be on any given
Yeah.
time based on what's happening in the market.
Yeah, it's very
So
active.
what would be the overall goal of a mutual fund? Like, why were they, started, created? What's the goal there of because it's got a lot of similarities to ETFs. So tell me, what is it trying to do, or what's it attempting to do?
So we're always trying to do better than the index. So if markets are going down, the mutual funds want to go down less than what it's comparing itself against. If markets are going up, we would like to go up higher than what the index is doing because we want to cover the extra fees that's associated with it. But both are very easy to get in and out of. So that really helps. And then mutual funds really help give another layer of diversification. A lot of the indexes out there, you can't have a combination of stocks, bonds, and international, where mutual funds actually give you all of that exposure and potentially one holding.
Kind of in one group or one mutual fund.
Exactly.
So you've talked a little bit about diversification already. Go into some of these other benefits we see on the screen here, and let's give people an idea of what they are getting into if they go the direction of a mutual fund.
Yeah, exactly. So not only can the management team do buying and selling, but typically they'll live around the world and really get a firsthand view of what's happening in different parts of the economy. We're here in Arizona. We're seeing what's happening on the news, but we're not allowed, we don't have the time to be all over the world to figure out what's going on. So
you don't?
These fund managers,
you don't globetrot on a weekly basis to come back here and tell me on a webinar what you've learned.
Yeah, so it's nice that we have people that can be all around the world and really giving us good opinions to what we think is going to happen, and where the thought is of market sentiment is huge. How people are feeling about things. An example is mutual funds and the buying and selling that they do. There might be times where, like when COVID hit, we needed to focus more in the US versus international markets. And those managers can make those changes for us. And we don't have to do anything. All we're going to do is we're going to be talking to our members about what managers are offering and doing for them. Some of the other things that I like is, when you look at like a fund manager that made adjustments, they might have sold travel stocks during the pandemic when everything was shut down, and they would have bought things like
no one's going to travel.
Yeah, they would have bought things like Zoom. They would have bought things like cardboard companies that are doing the boxes for Amazon.
Oh, for all the deliveries.
Yeah, exactly. So it's going to help be more profitable. Where the index was down 35%, a lot of the mutual funds really held together because they were able to make quick decisions on how to best navigate
kind of in the moment, day to day, paying attention to all of the information that is out there that we couldn't possibly be able to keep up with on a granular level like that from day to day. So it makes sense that is someone else's job.
Right. One unique thing too is when you're buying mutual funds, you can buy partial shares. So say you have $555 to do something with, we can fully invest that $555 in a mutual fund.
So how is that different? Like, what would my $555 get me in an index? Like what's the difference there?
Yeah, so if an index is at $10 a share to buy into that ETF, you're only going to be able to have, $550 put to work, and that other $5 isn't going to do anything for you.
Because you have to buy the full.
Exactly.
Okay.
Yeah.
So that's what that maximization item is, because you can buy partial shares of a mutual fund.
Exactly.
Anything else you want to talk about in this benefits section before we move on?
So both accounts will give you interest and dividends reinvested into the account. So as bonds pay interest because they're loans, and as stocks pay dividends, all that money is going to go back into helping grow the account. So, when we experienced days like yesterday in the markets where things were down, if we were doing more buying inside of the account with those dividends and interest from the end of the year, you're going to be able to buy things on sale and really help grow your number of shares faster. And then over time, the more shares you have, as the markets get better, you're going to see your money grow faster. It's going to compound.
So I hear that it's kind of a little bit of less worrying about those downturns.
Exactly.
Because you're just looking at it almost as an opportunity.
Exactly.
For future growth.
Yes, definitely.
Cool. All right. Are we ready to move on to the next
I think
slide?
so. Mm-hmm.
All right. So let's talk about the drawbacks. And actually, it just says drawback because I think it's really one major thing that you always bring up, because we want to be transparent with people and, let them know.
Right.
This is it. So tell us about the drawback.
So the drawback is fees. Index funds and ETFs are extremely inexpensive to get into. You could buy,
there's no management because of all the things we've talked about.
Right. And you could only buy one share of the index or the ETF, and that's all you have to buy. So you could spend $10 and essentially get invested in the markets. Where a mutual fund is usually going to have a certain minimum on the account that's going to be anywhere from $500 to $1,000 typically.
Okay. So there's a minimum.
Exactly. So I think that's, the biggest drawback. And then because we have to pay these fund managers to live all around the world, there's going to be a little bit more fees on those mutual funds. But, I've always argued that fees are only an issue in absence of value. And I believe that, these managers really add a lot of value to the account. When things are bad, they're going to lose less. And when things are good, they're going to do really well for you.
Yeah. So I don't want to get like too much into the weeds here, but just, can you explain a really basic level, the fee structure?
Yeah. So there's a few different types.
Like buy-in.
Yeah. So we've got what's called A shares, C shares, and institutional shares. So A shares are going to have an upfront fee of anywhere from, it really depends on how much you're doing. Usually the max is around 5.75%. And then they're going to be charged a moderate internal fee that you'll never really see. They're liquid accounts, so you can get in today and you can get out next week and not have a penalty to get out of the account. Where a C share is, there's no fee to get into the account. There's no fee to get out of the account, but they ask that you hold it for 12 months. If inside of those 12 months you close the account or you pull money out, there is a 1% penalty on the withdrawal amount that you take out typically. And then there's also institutional shares, which typically when you have $1 million, you get to buy in for free. And you have the lowest
so those are going to
internal
be
cost.
for like much higher dollar amounts.
Exactly. And then when we use our advisory accounts, which have a combination of mutual funds and those ETFs inside of it, those actually have institutional shares inside of them. So really for our members here at Copper State, we can have, a variety of different share classes in their portfolios to make sure that we're helping meet their goals.
Okay. So let's try to bring it back, because we've talked about several different things. Let's go to your key takeaways. Tell our audience what you want them to remember out of all the things we've talked about today.
Yeah, so I think it's so key to stay diversified. I hear every day of people talking about Bitcoin, people talking about gold and silver, and there's still stocks and what bonds to buy, and just really build out a well-rounded portfolio of a lot of different things, and you'll end up winning at the end of the day. We don't want to just pick one stock or one bond or, one Bitcoin and focus on only that. There's a lot of risk to that. And the whole thing we're trying to accomplish here is long-term growth. At Copper State Wealth Management, we're not looking to take $1,000 and turn it into $1 million overnight. We want to take your wealth and continue to grow it over time so that we can help meet your retirement goals and purchasing goals. If you want to buy a house and you have 5 years before you need to do that, we can help you grow those assets in the short term. So I think that's really important. And the nice thing is with having a membership at the credit union, myself, Anthony, and Tony, we're all here to, have that meeting with our members and sit down and figure out what it is. to support.
Yeah, and it sounds, the benefits of the membership are a member gets to sit down with one of you guys. There's no obligation, there's no cost, right? It's just,
Exactly.
let's take a look at what your goals are and we'll go from there. I'm going to give this opportunity if anyone has questions they want to pop over into the Q&A box, please go ahead and do that. Oh, I got a great question from one of our attendees today. So if you are a beginner investor, would you recommend a mutual fund versus micro investing in large companies like Apple, Tesla, etc.? Love that question.
Great question. So micro investing is absolutely one way to do it. That can help you when you have a really, really small dollar amount and you're just looking to buy bits and pieces over time. So that can be one way that you grow your assets until the point of being able to buy into a mutual fund. Most mutual funds today
So you
have,
look at it kind of as two steps. Like the micro is a great way to start when you're putting pennies or dimes or a couple bucks here and there, but mutual fund is almost a second step once you have a large sum.
Yeah. And then really, when we sit down with people, we want to make sure that we've got some money set aside in savings to cover any emergencies that happen. Make sure you've got a couple months of living expenses set aside. And then we really want to start looking at those investments. So micro investing is a great addition to making sure that we have, balances in the savings to protect you. But then once you get to a certain point, some of these mutual funds and ETFs can really help grow your wealth significantly outside of what those micro funds are going to do for you.
Okay.
Great question.
And I think, when it comes to one individual company, of course, that one company can always tank.
Yes.
So when we're going on the diversification bandwagon again, having a little bit of everything is nice. Well, I do have another question that came in, Ryan, from an attendee asking, how long do you recommend keeping a mutual fund for? That's interesting. I like that question.
Yeah. So really it's based on your specific goals. So I have had people buy mutual funds from 2008 that still own that mutual fund today. And it's done very, very well for them over time. I also have clients that, maybe they're going to buy a mutual fund today and maybe their needs are going to change in 2 years. You can usually do an exchange with the current company that you have funds with, and there's no fees to make that change. So maybe we're in a growth account with like a 529 for our kids.
Yeah.
And maybe they're getting closer to needing those funds and going to college. We can actually go and lower the amount of risk inside of the account. So maybe going from a growth to a moderate. And that way we can make sure that those funds are going to be there when we need to pull out for tuition.
So really, is there a minimum time frame for investing in a mutual fund? It sounds like there's really no maximum, because that just comes up to whatever's happening in your life.
Right.
When you need the money, you need the
whatever
money.
The goal is.
But when it comes to a minimum, do you have anything that you would share there?
Yeah. So minimum time frame, it really depends on the share class you buy. Typically the C shares you have to hold for 12 months. And then,
right. That's right.
Yeah. If you're purchasing an A share, it's liquid on day one. Okay. But you are paying a fee to get into that. And the more money you put into the account, you can get break points on the fees to the point of where you might be able to get in without paying a fee. But then that fund company is typically going to want you to hang on to those funds for at least a year.
Okay.
So what I see most
of it sounds like at least a year, because if you're paying the fees for it, you probably want to wait around until you make something
and really
good out of it.
We look at the break even between A shares and C shares. You're going to be anywhere from 5 to 10 years to the break even point. So for someone that needs the money in 3 years, a C share is a great fit. For somebody that doesn't need the money for 10 years and wants to start with something, very simple to read on a statement, but is very diversified inside of the account and professionally managed, an A share mutual fund works really well for those situations.
Yeah. And I know something that you guys always reiterate when you meet with our members, and something that's very important to me in financial wellness, is of course making sure you've got that emergency fund set up for yourself that's liquid, right? You want to have cash for a certain amount of time, a couple of months, that could get you by on your living expenses. A lot of people recommend starting with 1 month of expenses, but try to work your way up to 3 or even 6 months worth, and have that available in liquid funds, for when things come up, because then once that's set aside, you can go into the investment world and not have to worry as much about pulling that out if something unexpected happens.
Exactly.
Correct me if I'm wrong, Ryan, but I can't miss an opportunity to go
Yeah.
over that.
No, that's perfect. And I think it's great that, the credit union has better rates than your typical banks, which is wonderful. I really encourage people, 3 months is really the minimum expectation to have set aside in savings. I met with a member the other day that we recommended they have closer to 12 months based on their specific situation. So that's the good thing.
If you own your own business, or maybe you don't have health insurance or whatever, there's so many factors. It could definitely reach up towards that higher month mark, not to scare everybody away from saving.
Well, and I have friends that are in construction, and if it's raining, they're not working. And if you have a day off in the construction world because of weather, you're not getting paid typically. So you really want to make sure that you've got enough in savings to cover that missed day of work that you weren't really expecting to have. So things like that are really important to us inside of the accounts.
Yeah. Now, if you have a couple more minutes, we do have a few more questions that I think are just amazing.
I would love to help.
So our next question is, do you predict mutual funds being an evergreen investment product? So is it always going to be there? Is it going to be something that's consistent?
Yeah, I think mutual funds are here to stay. I think they're always evolving, which is great. There's been some talk of like a balanced portfolio, a 60-40, maybe not doing well, given where the bond interest rates are at. We can all see in our bank accounts, our interest rates are very low. They've been low for a long time. Because of that, there's a lot of concern that, maybe these moderate and conservative mutual funds, maybe it's not worth it to have certain things inside of the account. But we're just going through a season in investing. And, prior to the 1980s, interest rates were going up. We're going to see at some point, interest rates are going to start going back up. And we really want these bond managers to be active and to continue to, manage the account, manage the expectation, and think about, we might not make as much money as we did over the last 20 years in these moderate accounts, but we're still going to, most likely make more than what's in a checking or a savings account.
Awesome. Looks like we have one more question for you before we sign off today. What are some other investment options you would recommend beginner investors to research? Oh, I love this question. Yeah. So you've got mutual funds. What else? What else can they look into?
Yeah. So there's a lot of different things that are out there. Everybody's talking about Bitcoin these days. So that's something where you can go on to some of these online trading platforms and you can get access to that. Just be very careful.
Another one, right? Isn't there another one now? It's not even Bitcoin.
Yeah, there's NFTs that I've been hearing actually a few people recently talking about.
There's a new crypto that's out.
There's
a lot of buzz.
They're coming out with crypto all the time. There's NFT funds which get you exposure to some of the newer things that are like the newer companies that are going public. There's obviously the ETFs are a great way to start.
Yeah, so ETFs, indexes. I mean, you can buy individual stocks of individual companies. I had a friend who worked for Apple and got like a discounted rate on their stocks, and so she has Apple stock and she's had it for 10 years.
Nice.
But so you can do the individual route, you can do the index ETFs, you can look into mutual funds, there's cryptocurrency. What else are we missing?
So if we're later on in life and we're over our mid 50s, there's different types of annuities that are available that can be ultra conservative, paying fixed rates. But what I always recommend to people, it doesn't matter the dollar amount that you have a conversation with one of us. We can go over what your specific goals are, your specific situation, and then we can help, make a proper recommendation based on that. And even if it's not with us, we're going to want to help you get started and get you guided in the right direction.
Yeah. And it's really such a specific thing that, whoever has the question and they bring it to you and they're sitting across the table from you or from Anthony or from Tony,
right?
That's a one-on-one, like we're talking about your finances and we're going to find a solution that works for you and give you all of the options that there are. So
Yeah.
I like that. I like that as an answer. I do want everyone to know that we have, obviously we talked about how we have advisors at every branch. The conversation is free. You can determine your risk preferences, talk about rollovers, all that fun stuff. Please take advantage of that. And then we do have an infographic for everyone. I just thought it was a very nice way to visualize the difference between mutual funds and ETFs. That tends to be the biggest conversation is index, mutual fund, what's the difference? I don't get it. So we've got a nice little infographic for you. Take the survey. You should see it in the exit page. As you exit out of your Zoom window, you should see the link there. You'll also get an email. You do need to take the survey in order to get the infographic, but we are very excited that everyone joined us today, and just thank you so much. Thank you, Ryan. Always a pleasure. Anything else you want to leave everyone with today?
No, just thank you for taking the time out of your day to hop on and learn a little bit about some of the different options that are available. And if anybody has any questions at all, feel free to reach out to me at any time, and I'm here to help.
Awesome. Well, thank you so much. Thank you, everyone, for joining, and we'll talk to you next time.
Thank you.